In 2014, Cathie Wood founded her own investment firm called Ark Invest, which now manages a staggering $60 billion. In 2020, while the S&P was up 17% and the Nasdaq up a staggering 43%, her ARKK Innovation ETF skyrocketed 151%. Since inception, her flagship fund is up 225%, while the S&P only returned 146% and the Nasdaq 212%. But recently, it's no secret her fund has run into problems. Over the last 2 years, her fund returned 19%, while the S&P 500 and Nasdaq climbed 26 and 29% respectively. Has she lost her touch, or does she see something traditional portfolio managers have missed? Cathie recently spoke about the current economic conditions given the backdrop of the Russia-Ukraine war and detailed her economic outlook and investment thesis. In this video, we'll discuss her thoughts and some of her recent trades. Before discussing her economic views, we must discuss her investment thesis, which will help explain her recent performance. As Cathie Wood puts it, her flagship innovation fund invests in disruptive companies. These companies have technological innovations that could potentially change the way the world functions. Think of it of choosing stocks that will become the next Google, Amazon, or Meta. Recent examples of this would be Coinbase, Snowflake, and CrowdStrike. However, these stocks can trade at expensive valuations. Innovative stocks trade at a high price-to-earnings multiple or P/E ratio. The price-to-earnings ratio is often used as a comparative metric, but it can also be thought of as the number of years it takes for a stock to return the entire market cap. For instance, if a stock has a P/E ratio of 30 and earnings were constant, it would take 30 years for the company to earn the amounts of money invested. If you invested $100 in a company with a P/E ratio of 5, the company would earn $100 for your equity after 5 years, assuming all the variables are constant. ARK's analysts frequently compare P/E ratios against companies in the same industry. For example, you would not compare a utility company's P/E to a retail or software company. This is because each industry has different tailwinds, capital structures, consumer behaviors, etc. Google is a perfect example of Cathie's philosophy. In 2005, Google was an innovator and traded at a premium valuation. It traded at a 50 times price-to-earnings ratio, while the Nasdaq traded at 25 times earnings. Based on Google's P/E ratio in 2005, you would think the Nasdaq would have been the better value, as the Nasdaq was 50% cheaper, but that's definitely not the case. In fact, it actually took several years for Google's stock price to trade at roughly the same P/E as the market. Cathie is patient and focused on the long term, and the price to earnings does not include the expected growth of the earnings. Cathie Wood looks at the price to earnings to growth rate, or PEG ratio. To understand this, we need to compare two stocks. Stock A is trading at $25 and has earnings of $1 per share. Stock B trades at $25 and has $1 of earnings as well. Both trade at 25 times earnings, or 25 P/E. They would appear to be the same value, but they aren't if earnings growth rates are different. If stock A is expected to grow earnings at 10% per year and stock B at 50% per year, then analysts will have to make an adjustment to the P/E ratio. This is done through the PEG ratio by dividing the P/E multiple by the growth rate. And in this case, the 5-year expected annual growth rate is used. In this case, company A's price to earnings to growth rate, or PEG, is 2.5x, while company B's is 0.5x. This is one of the items that Cathie Wood looks at. She is not looking at just the current earnings multiples, but rather the PEG ratio 5 years from today. Turning back to our Google example, it might look like investors in 2005 would have been better off owning the Nasdaq, but this can't be further from the truth. Since April 2005, Google returns 2,532%, while the Nasdaq returned 548%. In fact, Google almost doubled the 13% annual return of the Nasdaq. This also includes the recent COVID crisis and Ukraine-Russian war. Investors should be looking for the next Google, and that's exactly what Cathie Wood is looking for. She focuses on innovative technology, which means her stocks will have a high P/E ratio. Her analysts make comparisons using the PEG ratio to determine value. High P/E ratios and growth rates can be volatile in relation to stock prices, but volatility is not always horrible because it also works on the upside as well. Here's a chart of Cathie's top 5 holdings: Tesla, Teladoc, Roku, Zoom, and Exact Science, along with Nasdaq graphed with their PEG ratios. In this chart, the ratios are normalized against the Nasdaq, which means that the ratios are relative to Nasdaq's PEG ratio at 0. While the Nasdaq's PEG ratio is currently lower than 4 of Cathie's top 5 holdings, only Teladoc and Tesla have consistently traded well above the Nasdaq's PEG ratio. And here are Cathie's next top 15 holdings in ARKK. The key here is that only 4 stocks stand out as trading well above the Nasdaq's PEG ratio. The rest are still elevated, but near the Nasdaq's PEG rate. Keep in mind that the Nasdaq also includes stocks that are not in the technology sector like Starbucks. ARKK's holdings appear to be underpriced relative to their peers. Over the next 5 years, Cathie Wood believes the earnings of these disruptive firms will explode. While not all of her picks will be winners, some might grow to be the next Google or Tesla. This volatility helps explain why Cathie Wood's ARKK ETF has traded down the last 2 years compared to the Nasdaq and S&P. Cathie Wood recently discussed why these stocks have suffered, but is this a buying opportunity? To understand this, we have to dive deep into the economy. In Cathie Wood's case, the combination of high inflation and the Russian-Ukraine war has driven down ARK's valuations over the last 2 years. Speaking of high inflation, did you know blue chip art is a fantastic way to hedge your portfolio against excessive money printing? This might be surprising, but 61% of all millionaires and billionaires invest in art to diversify their portfolio. Contemporary art prices experience an average annual return of 14.1% per year, significantly higher than the S&P's return of 9.9%. Blue chip art used to be exclusively available to the richest investors, but the sponsor of this video, Masterworks, is changing that. Masterworks is a platform where anybody can purchase shares of expensive art, and this not only enables you to add art to your portfolio for much cheaper than normal, it allows you to diversify with multiple paintings. Masterworks has sold 3 paintings, with each returning over 30% net IRR to investors, and their new offerings usually sell out in hours. 30+% is wild. Luckily for viewers of the channel, you can now skip the waitlist and start investing today by going to masterworks.art/Cascainsacademy, or just by clicking the link in the description. It's a great way to learn more about art as an asset class, and I would highly recommend considering diversifying your portfolio through Masterworks. Thanks to Masterworks for sponsoring today's video, and with that being said, let's get back into the video. Cathie blames algorithmic traders for the mismatch between long-term investments and short-term trading. Algo trading is always short-term focused, and is highly dependent on the US economy, market direction, and changes in rates. For instance, when rates are expected to go up, algo traders often buy into banks and utility companies to benefit from rising rates. Algo traders are also selling high multiple stocks due to changes in the economy. Cathie mentioned specifically that algo traders were selling stocks based on cash burn rates and cash cushion levels. These metrics are proxies for how much cash the firm has available and how fast a company burns through that cash. Remember that as rates increase, borrowing money becomes more costly. Over the last 2 years, rates have changed drastically. In 2018, interest rates were near 3%, and now they are between 0.25 and 0.5%. All of these macroeconomic factors affect ARK's holdings. This next chart compares the 2-year Treasury yield to the S&P 500 and Nasdaq. Notice that in the last 2 years, rates went down because the economy was suffering. The Federal Reserve's actions helped push the economy into a V-shaped recovery and the market rebounded. The real story is in the P/E ratio and rates. When adjusting the previous chart for P/E ratios, we obtained this next chart. Here you can clearly see the 2000 Nasdaq bubble, and more recently, the stretched valuation since 2020. As rates climb, the market is due to pull back. Cathie Wood appears to be right as of now. The combination of rising rates and the war has caused algo traders and short-term investors to punish innovative stocks which trade at high P/E multiples. The higher the multiple, the greater the decline. Take a look at the chart of ARKK's price performance relative to interest rates. But what about the PEG ratio? Cathie Wood stocks might be underpriced on a 5-year PEG basis, but investors are looking at the short term, not 5 years. Investors should be patient, but many are concerned about the economy. Cathie Wood broke down the economy into several basic pieces: monetary policy, fiscal policy, and economic activity. Monetary policy is what the Federal Reserve does with interest rates and the money supply in the economy. The Federal Reserve's goal is to keep people employed and interest rates stable around 2 to 3%. That also means inflation should be around 2 to 3%. Investors today are scared of the threat of inflation. Take a look at the commodity prices over the last year. These are scary price increases that act as a direct tax on the consumer. Gas prices are reaching $5 and even over $6 in some locations, and oil has continued to climb to $110 a barrel. Lumber prices have also been pushing housing costs higher too. Cathie believes inflation is not here to stay. This longer-term CPI chart puts a better perspective on inflation. Since the 1990s, inflation has been tame compared to the 70s and 80s, and especially since the early 1900s to 1940s. Today, inflation stands at 7.5%, which is the highest it's been since the early 1980s. The expectation is that inflation will likely reach 10%, but one has to question whether that'll actually happen. Cathie is one of those people, and this is because while costs are rising, inflation is dependent on several factors. One of these factors is how often money switches hands, also known as the velocity of money. Using M2, which is a measure of money in the economy, the velocity of money was 1.1 times in the fourth quarter of 2021. The velocity has been decreasing significantly since the 2008 crisis. Cathie argues that during the 1970s and 80s, the velocity of money was high, and this contributed to higher inflation rates during those periods. In the 1960s, the velocity of money increased by 21%, as many people purchased goods and services right away. People were afraid of prices increasing, so they bought goods as quickly as they could. This became a self-fulfilling prophecy, as the high velocity meant that prices just kept rising higher and higher. This chart compares core CPI, which is the consumer price index without energy and food prices, to the S&P 500 and M2 velocity. Since the third quarter of 1997 to 2021, velocity of money has significantly declined. As M2 velocity declined, the market began to take off, and inflation became less of an issue. Cathie believes this will keep longer-term inflation in check and prevent the Federal Reserve from raising rates too quickly. Additionally, she stated that consumer sentiment, or the expectations consumers have to buy new goods like cars, beds, and TVs, has declined significantly. As seen here, consumer sentiment has climbed since the 2008 Great Financial Crisis until dropping recently. The latest downturn could contribute to keeping wages and prices from rising to all-time highs. The CPI without food and energy is shown here but scaled to 10 times. Consumer sentiment tends to impact inflation figures, and the current sentiment indicates that the recent inflation might be short-lived. Cathie also mentioned the higher energy consumption as a percentage of GDP as another taxing item on the consumer to limit inflation in consumer goods. Government spending is also another reason why inflation will be short-lived. The current administration has been focused on reducing government expenditures. In 2008, the government spent money to maintain solvency in the banking system. A more drastic version of that took place in 2020, although it's starting to cool down. On a year-over-year basis, fiscal spending increased 18% in Q4 of 2021. Like the period following the 2008 recession, fiscal spending will certainly continue to decline on a year-over-year basis. The 2020 jump was from over $7 trillion in additional spending that the Fed is working on removing from the economy. That government spending resistance alone will help stop inflation. Other factors that Cathie discussed are unemployment figures, wage growth, and labor force participation. As seen in this chart, labor force participation recently increased, but non-farm payrolls declined. More people are working but at a lower overall wage. In the 1960s and 70s, non-farm payroll continued to increase until Fed Chair Paul Volcker started raising rates to slow inflation. At the same time, labor participation declined as jobs became hard to find. This is the opposite of what is happening today. Jobs are easy to find and wages are going down. In one of our more recent videos, we discussed the supply chain stress in the economy. Cathie also watches the inventory levels of retailers to get a handle on inflation. Businesses are seeing their inventory start to return lately. Recently, Goldman Sachs reduced its supply chain stress index from 10 to 9, and more recently to 7. This chart shows a percent change in inventories from the prior quarter. If consumer demand were increasing, inventories would not be building as we see here. So where does this put interest rates at? If Cathie is right, this means that the market is wrong about inflation, and the Federal Reserve will not raise rates as abruptly as expected. Cathie stated that she believes the Fed might do an additional rate hike from the recent one and be done. According to Bloomberg, the rest of the market anticipates numerous rate hikes and expects rates to increase to 1.78% from current levels. If Cathie is right about rates and inflation, her stocks will likely rebound significantly as rates remain low, inflation is under control, and multiples start to expand again. The downturn seen in the latter half of 2021 and early 2022 was a drop of 50% in just a few short months. Long-term investors are looking beyond this short-term volatility for long-term returns. Cathie's thesis is also confirmed by private equity funding rounds. While innovation stocks have taken a tumble, private early innovation investors have seen valuations increase over the last 2 years, especially since the last few months. Out of the 379 Series C and higher rounds of capital raising, the valuations increased from 2.2x to 2.8x between November 2021 and February 2022. Series C is a form of older capital raising in the private market. There is some lagging effect in this chart, but in December 2021 and January 2022, valuations in the private equity space stayed strong while the equity markets declined. So what does this mean for Ark and Cathie Wood? Her recent performance has been at the hands of short-term traders, difficult market conditions, and a war. Inflation is not likely to get out of control because of the factors we talked about earlier. The Fed will not likely have to raise rates as drastically, which will provide an uplift to equities. If you believe in Cathie's economic outlook, you should look to invest in the long term. Cathie's more recent ARKK trades include selling shares of Selectus, Palantir, Aqua Bounty, Trimble, Evogene, Open Door, Lending Club, Lockheed Martin, Intuitive Surgical, Twitter, Etsy, and Insight. Some of her more recent purchases include Burning Rock, 908 Devices, Joby Aviation, Velo 3D, Adaptive Biotech, Codexis, One Life Healthcare, Stratasys, Two Simple Holdings, Square, DraftKings, and Shopify. Let me know what you think about Ark Invest down below. Do you think this is a great buying opportunity, or is it simply a bull trap? If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.